What's up everyone, it's Caddy with Money Vesting. In this video we are going to be talking about the critical area of resistance that everybody is going to be watching now for the S&P 500 and the Nasdaq as we now approach these levels, and it all comes down to the bulls and the bears for us to figure out exactly where we are headed from these levels. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you want to be a part of our money investing community, take a look at that link down below. You can get access to all the buy and sell alerts, options alerts, trade ideas, all the member benefits, including all the private videos, lectures, and tutorials as well. So in my previous videos, in fact, literally in my yesterday's market update, I mentioned that this is going to be a very, very big testing point for the market because we are coming up to this level and we have gotten rejected at this price point not once, not twice, not 3 times, but 4 times for the S&P 500. So before we jump into the charts, let's talk about the JP Morgan report that came out today suggesting exactly the same thing. So this right here is the report. And you'll notice the S&P 500, S&P, SPX is trying to get through the 4,200 level for the 5th time, and this has been our line in sand all year, and there's no reason to change that approach now. It's a 161.8% retracement from 2020 decline, and it also marked a key low earlier last year before the bear market rally got going, and it's been a resistance for 10 months. So you can see that that's pretty much been the levels of previous support level acting as a resistance, right? So acting as a resistance here, and then we briefly broke out of that level, you can see right here, and then we came right back down to hit a new low back in October, then got rejected once again, couple times over here, and now you notice the S&P 500 is back above 4,100, testing that level once again. It's going to get quite interesting. I'll go over some of the individual charts here as well. Now, when it comes to the Nasdaq, you'll notice that we are in a very similar situation. So it is a similar story for the Nasdaq, where they are focused on 11,800 to 12,200, exactly precisely the points that I've also mentioned. And again, these aren't just numbers we're pulling out of the hat. 12,000 is the 161.8% Fibonacci retracement level from the COVID sell-off, and the markets respect these fib levels, so we do too. And this right here is going to be the Nasdaq chart, and once again, you'll notice that we are coming up to this resistance where exactly we have gone rejected 3 times for the Nasdaq, which was historically a very, very significant resistance area for the markets as well. So this is, I believe, from back in 2021. So now jumping over to the charts, and before we do that, I want to quickly go over this right here is the relative performance chart of some of the big tech companies, right? So we got Meta, Apple, Amazon, Netflix, Google, Microsoft, Nvidia, and Tesla. And I want to show you a little bit of divergence because I've talked about how there is a bit of a concentration risk in the markets right now because a lot of the big tech is really what's driving this move higher, and we're not really seeing a lot of broad-based rallies, right? That was also a report that came out on CNBC yesterday, and I've already talked about it prior to that report being released, but we talked about how this is not necessarily a broad-based rally, but instead very much concentrated on big tech. So if you go back to when the sell-off pretty much began in 2021, what we really witnessed was the tech sector was weakening before the market made a new all-time high, right? So these sectors collectively were making a lower high. That was a lower high back then, back in December 21, and the S&P 500 still ended up making a higher high. So it actually made a new all-time high in December 27, 21, even though this index was making a lower high. So there was a negative divergence, right? Bearish divergence because there was weakness in tech brewing underneath. And what happened, of course, as tech started to sell off because of higher interest rates and inflation all of 2022, the markets obviously sold off pretty aggressively. They were down 20-25%, entered a bear market. And then what you'll notice is that in early October, September, October, around that time, we started to see a bit of a bullish divergence. Not so much from the tech sector because we didn't really get a higher low, but we did get a higher low on the S&P 500 because there was a lot of momentum in other parts of the market. There was a more broad-based rally. And as a result, as the tech sector, in other words, the big tech was selling off, making a new low in December of 2022, so pretty much an entire year from top to bottom, from peak to trough, the S&P 500 was already on its way up. And then as tech picked up steam, then S&P 500 pushed up even higher because of this concentration in tech. So what we really witnessed in another sense is a lot of broad-based rally back in October, November. And then we started to see tech really kick off in January, February, or March of this year. And that's really what's been driving the markets higher, of course, with the NASDAQ obviously up over 20%. Another chart that I want to share with you that I think is very interesting. By the way, this is the S&P 500 Equal Weighted Index, also known as the RSP. You can take a look at this let me show you another chart here. And that's going to be RSP. That's the indicator that's equal weight, right? So all 500 companies have an equal weight in the S&P 500 in this particular index. And what you'll notice is that it is nowhere near close to its recent technical resistance of 150, but instead it's a lot lower at 144 as opposed to the SPY, which is obviously a lot closer to its previous resistance at roughly around 410. So that really does suggest that the higher weighted stocks are putting a lot more impact on the S&P on the way up, as opposed to us seeing a more broad-based rally. This right here is another survey. By the way, I'm going to be doing a separate video on commercial real estate because there is some fear of contagion with the banking crisis and kind of moving over to commercial real estate. So JP Morgan actually did a survey and they asked this question: what do you believe is a likely cause of the next market crisis? And 35% of participants mentioned commercial real estate. So I will be doing a video on this in more specific detail because there's been a lot of small banks, long community banks that have been financing a lot of these commercial real estate deals. And as interest rates go up, these lenders are finding it difficult to meet up with these obligations because the borrowers for the commercial real estate projects, as interest rates go up, their interest expense also goes up. And that's going to be a little bit of a blind spot that I want to talk about in another separate video. But going back over to the technicals here, this is another chart that I want you to pay attention to. And this is really just S&P 500 stocks trading above their 20-day moving average. So very, very short-term momentum. And what you'll notice is last week, this indicator was up 171%, now getting up to over 87%, meaning that almost 88% stocks are now trading back above their 20-day moving average in the S&P 500. So that is a very, very short-term moving average, gives you a little bit of an insight into short-term momentum for the market. And now we're once again inside this red rectangle, similar to what we have seen before in previous instances. Every time we get up to this level, we do see a bit of a pullback. Now, I know the comment section may not be super happy because I'm once again, calling out for a potential pullback here. But look, if the markets rally, that's great. I'm all for it. I'm still long. I'm still overweight tech. But it's my job to kind of show you the data, and it's literally right here. Every time we have gone up to this level, we have seen a bit of a pullback. Now, that doesn't necessarily mean it's going to absolutely happen, guaranteed happen. There's no such thing as guarantees in the market. It's possible that we get up to 90%, maybe 92, 95, 96%. But eventually, there is going to be a time where the market on a short-term basis will start to become a bit overbought, and it will be time for us to pull back, just a brief pullback of 4 to 5%, maybe even 6 to 7% moving forward. Now, S&P 500 stocks trading above their 200-day moving average. It is not as high. In fact, last week, this indicator was up 37%, as you can see over here. And right now, we're trading at 56, meaning just a little bit over half the market in the S&P is trading back above its 200-day moving average. So we're still far off from 94, 95%. In fact, the recent pullback back in February, we did get up to as much as 80%, 75 to 80%. And that's why we did see about a 7 to 8% pullback on the market. And this time around, we are almost getting back to that same level with fewer stocks back above their 200-day moving average, right? So again, think about that for a second. For the S&P 500, we are back to the same level where we were back in February, but with fewer stocks. I think we are slightly lower on the S&P 500. I could be wrong. Let me just take a quick look. So back in February, this is back in February right here. Yeah, so that's actually, we are almost at the same level as we were back in February. So we're only off by 40, 50 points. And yet there is a gap of about 30% fewer stocks. That means it's very concentrated behind a lot of the tech stocks. So now going back over to the S&P 500 here, let's just quickly break that down. And I'm going to remove this S&P over here. And the level that we're really watching is going to be inside this red rectangle. That's where all eyes and ears are going to be focused on. All technical investors, fundamentalists, economists, everybody's going to be focusing on S&P 500 between 41 and 4,200. That 100-point gap, we'll see if we actually do break out above this level and continue to make a move back up to 4,300, or if bears step in to bring us back down at this level. And of course, the NASDAQ also, we're now approaching inside this red rectangle, sitting roughly around 12,200 levels. So very, very important week. It is a shorter week, so we've only got 3 more trading days, and we've got a lot of JOLTS numbers, jobs numbers, ADP numbers. Everything's going to be coming out. So it all comes down to these resistance areas, which is going to be a big testing point for the market. Let me know in the comment section down below, what do you expect, breakout or a rejection? Let me know in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining us and getting access to all the Binance alerts, options alerts, trade ideas, and all the other member benefits. And as always, happy investing. I'll see you all in the next video.